The way that I wrote out the operating activities section here, where we have cash received from customers, less cash paid out for operating expenses, this is known as the direct method, where we're just stating the cash receipt and paid out directly. GAAP does allow this method, and in fact, it highly encourages companies, those are the words in GAAP, it highly encourages companies to use this direct method. But what do we do when somebody highly encourages us to do something, right? What do you do if your parents highly encourage something? Well, you do the opposite. So GAAP also allows what's called the indirect method. Now we're only talking about the cash from the operating activities section. The investing and financing sections, there's only one method of doing it, but in the operating activities section, it can be reported in either the direct method, reported using the direct method, cash received from customers, cash paid out for these expenses, or the indirect method. And nearly all companies use the indirect method. We saw that Home Depot uses the indirect method. And that's the method where we're starting with net income. Start with net income, and then you make adjustments from net income to get to cash from operating activities. Either way, either method that the company chooses to use, they're going to get to the exact same dollar amount of operating activities. It's just how are we going to get there? How are we going to report it? And let's take a quick look at a visual here. Here's the income statement on this left-hand side where we have our revenues and then we add gains, losses, and then we have our expenses. So what we said, typically all the items from the income statement are going to be somewhere on that statement of cash flows. If we had the direct method, we would have cash received from customers, revenue received, dividend, interest revenue, a non-cash gain, a gain on the sale of a building is not going to be reported. That gain, we're going to get cash from a sale, but if it's a building or equipment, it's going to go in the investing section. Less the expenses, cost of goods sold would be inventory. We have salaries expense would be cash paid to employees. Depreciation, amortization, a loss on a sale of assets. These depreciation and amortization, non-cash expenses, sales of assets, long-term assets, going to be in the investing section. Interest expense, cash paid to creditors, other cash paid for operating, and cash paid to the government for your income tax expense. This is all in the direct method, but it kind of lays out what these cash payments are. What we're going to do is begin with net income and then make the adjustments for the differences between what happened on the income statement and what actually happened in cash. Let's start our statement of cash flows, the operating section only. What would it look like using the indirect method? We always start with the company's net income taken straight from the income statement. Obviously, if we're producing a statement of cash flows, we work for the company, so we have the net income not simply from the income statement, but from that trial balance. And then what we're going to do is we are going to adjust for what items did not affect the cash from operating activities, but did affect net income. Okay, so we're going to add depreciation and amortization expense. The reason that we do that is that these are non-cash expenses. So they reduced our net income, but they did not affect operating activities. Decrease net income. And so what we're doing by adding the depreciation expense is we're reversing it out, or we're undoing that depreciation expense, taking it out of net income to get down to we're eventually going to come down to cash from operating activities. Now, don't write that part down because we're going to need some more space, but that's what we're doing. We're making adjustments. If we had depreciation of 10 million, we're going to add that back because it reduced our income. And what we're trying to get to is the cash from operating activities. And on a cash basis rather than accrual basis, there was no cash received or no cash spent. Okay, the next thing we're going to do after adding back the depreciation and amortization expense, and of course the order does not matter, let's add back any losses on sales of long-term assets. Such as long-term marketable securities, plant, property, and equipment, intangible assets. We sell them for less than the book value. That's going to end up with a loss on an accrual basis. Now you might be thinking, what we're getting cash, but we're going to subtract out the loss. The cash that relates to what we receive when we have the sale is going to go into the investing section, but the loss that's included in net income has to be reversed out. So this was, I'm just going to write a note here, is that any cash received related to these long-term assets is in investing activities. But take out any loss from that net income, and likewise do the opposite, subtract any gains on sales of assets. All right, so we're just reversing these things that did not affect cash from operating activities. And next, we're going to adjust for our changes in our operating assets and our operating liabilities. Let's start with the rule, and then we'll go through the why. We are going to subtract increases in operating assets. Now, operating assets are generally going to be your current assets, but not always. Operating assets other than cash. Okay, so what are we talking about with these operating assets? Accounts receivable, inventory, supplies, prepaid assets, let's say prepaid insurance, prepaid rent, prepaid taxes. Notes receivable would not be included because they would be considered investing assets. Marketable securities, only if short-term, if long-term, they would be in the investing section. You could have a long-term asset. The only long-term operating asset I can think of would be something like a 3 or 4 year, anything more than 1 year, prepaid insurance. That could go in the long-term, but it would still be classified as an operating asset. But for the most part, these are going to be your current assets. And so you're probably wondering why we do this. And so I'm going to show some examples on a separate page. Start with a separate page here. And let's start with looking at accounts receivable increased. And so we're going to ask ourselves for each of these items, what must have happened? Why are we, so remember the big question is, if we are starting with net income on our statement of cash flows, if we are starting with net income, if we're starting with our net income here on our statement of cash flows, why would we subtract out an increase in something like accounts receivable? Okay, so we know accounts receivable went up. Let's start with what would that mean? If accounts receivable went up, there's only one thing, that this must mean that sales increased. It's the only way for an account receivable to go up. And so I'm just going to throw some numbers in here. I'm just going to completely make them up. Let's say sales were 50 million and accounts receivable for the period. During the period, sales went from 0, of course, in the beginning to 50. And the accounts receivable went, let's say, from 0 to 10. It doesn't matter. It could have gone from 40 to 50. But accounts receivable increased by 10. Let's just say went from 0 to 10. What would that journal entry look like? So we would have accounts receivable, increased debit accounts receivable for 10. Let's say these numbers are in millions. We have sales revenue increased by 50. And so what would have to go here? The only way that accounts receivable could go up, it has to be the other thing has to be cash went up by the difference. So let's look at the income statement here. When you start with net income, what would happen? You'd have sales revenue of 50, let's say based on this entry, no expenses. Net income was 50. We can see here what was cash from operating activities. Cash from operating activities we know is 40. So how do we get from the 50 down to the 40? We have to subtract out the increase in accounts receivable. And you can plug in different numbers here and you'll still come up with the same thing. We can have beginning balances of the accounts receivable and we can see how this would work. All right, what else did we have in here? We had inventory. Let's take a look at inventory going up. Okay, let's start by assuming, and we're going to make different assumptions, but right now let's assume all inventory purchases are done in cash. Okay, let's say our inventory went up 30 million this year, and we sold, so we purchased inventory. Inventory went up because we purchased 30 of inventory, and then we sold $20 million. Okay, so what would this journal entry look like? This would actually be two entries. So first we purchased the inventory for 30, and all purchases were in cash, so this would be an operating cash outflow of 30. And then we sold 20. This would mean cost of goods sold went up for 20, and inventory decreased because we gave up our inventory at its cost of 20. And so the net of these two entries means that our inventory went up a net 10. And what if we're reconciling from net income? Across these two entries, we had net income decreased by 20 because we have nothing but an expense, cost of goods sold. And we know that our operating cash flow, or cash from operating activities, must be a credit to 30 is negative 30. So how do we have an increase in inventory of a net 10. So how did we get there? We have to decrease inventory by 10 to get to this negative or cash outflow that ties to this journal entry here. All right, what about prepaid insurance? We see that prepaid insurance is another. If we have an increase in prepaid insurance, or any prepaid asset, let's just take prepaid insurance as an example. The only way to get a prepaid is to be in cash. That's the definition. We pay off the cash in advance of getting that asset. So let's say over this accounting period, we purchased 100 of prepaid insurance. And then over the period, we used 90 of the prepaid insurance. What would those entries look like? First, we buy it and we debit the asset, prepaid insurance, for 100. We give up cash, so we have a cash from operating activities outflow of 100. And then during the period, we use some of it. So we have insurance expense of 90, and we reduce the asset, prepaid insurance, of 90. So what happens at the end of the period? I have a balance of 10 in the prepaid insurance. And what do we do on the statement of cash flows? Just from these two transactions, net income we see here, net income is negative 90 from our insurance expense. We see that our cash is an outflow of 100. So operating cash, outflow of 100. So how do we get to that? Well, we had this decrease. We started with 100 in our prepaid insurance, we have an increase. We started with 100, we used up 90. So we have an increase in prepaid insurance of 10, and we need to subtract out that in order to reconcile our net income to our operating cash flows. So that shows why we subtract an increase in those operating assets. If we subtracted an increase in operating assets, then we have to do the opposite if we have a decrease in operating assets. So we're going to add decreases in those same operating assets. Let's take a look just very briefly at one example. Let's say our accounts receivable decreased this period. Well, the only way for an account receivable to decrease, it must be that we collected more cash than we had sales this period. So we can't start with a zero balance and see accounts receivable decrease. We had to have a beginning balance. So we collected more cash this period than we had sales revenue this period, or in other words, we collected cash from a previous period sale. So revenues were recorded in a previous period. Our receivables or cash was collected this period. Okay, so what would that entry look like if we had, let's say we had sales revenue of 50 and our accounts receivable decreased by 10, so a credit to accounts receivable. What would have to be the other side of this journal entry? It would have to be that we collected cash of 60. And so we can kind of back into what that cash would have to be based on the journal entry. And then if we did our reconciliation, in this case, our net income was 50. We know that our operating cash was 60. And how do we get there? We add the decrease in accounts receivable for 10. All right, so we subtracted out increases in operating assets. We added decreases in operating assets. We are going to add increases in operating liabilities. Okay, what operating liabilities are we talking about? Accounts payable. And then accrued liabilities. Accrued liabilities is nothing more than just kind of miscellaneous payables from operations. So they might be things like salaries payable, interest payable, income taxes payable, any other payables. Also, one other item we might see, unearned revenue. Okay, let's just take a look at one brief example. Earlier I said that inventory was purchased all in cash. Let's assume that inventory is not purchased all in cash. Let's say that inventory increased by 10 and accounts payable during the period increased by 20. Okay, so we're going to assume that we purchased, based on this, let's assume that we've purchased, during the period, we purchased 30 on account. And that we sold 20. So what would our journal entries look like? Inventory went up 30, accounts payable went up 30. Oh, sorry, this accounts payable here should be 30. Inventory went up 30, accounts payable went up 30, and then we sold. So cost of goods sold went up 20, and then inventory, we gave out up inventory worth 20. So what do we have here? We have our inventory went up a net of 10, our accounts payable went up 30. And so we can see here easily, net income is a negative 20. And cash from operating activities is 0. So let's put that into our reconciliation. Net income is just this one expense of 20, and operating cash should be 0. No cash was paid. So what do we need to do? If inventory went up, subtract the increase in inventory, the operating asset, so subtract out 10. And then we're going to add the increase in the operating liability. Add the increase in accounts payable. And that gets me exactly where I want to be, to operating cash of 0. We can look at an even simpler one and just say, what if the company got a utilities bill and didn't pay it? So accounts payable went up by 10, and then because of a utilities bill, what would that entry look like? We received our utilities bill, so we record utilities expense. We don't pay it, so we have a payable of 10. When we're doing our reconciliation, net income is negative 10. Operating cash is 0. And so we see that we must add the increase in the operating liability in order to get there. We can play around with different numbers, make different situations. I like doing the journal entries because then it helps me to see what happens to the cash, what happens to the income, and that's why there's a reason for the adjustment. Okay, we add the increase in the operating liabilities, and then we do the opposite. We subtract any decreases in operating liabilities. Okay, let's take one example without even writing it out. If accounts payable decreased, what must have happened? Accounts payable would relate to an expense from a previous period if it was something like utilities expense. So nothing happened to income this period, but we had a cash payment. So cash from operating activities decreased. So of course we would need to subtract that to go from net income down to cash from operating activities. And that's it for our operating section using cash from operating activities using the indirect method. We have our net income, we have a whole bunch of adjustments, and then we get to our cash from operating activities using the indirect method. Let's take a look back at Home Depot's statement of cash flows. In the operating section, we see net income as the top line. Then we have add back, depreciation, and amortization. They mentioned stock-based compensation. That is a non-cash item. It reduced income, so it's added back here. We see changes in receivables, inventories, other current assets, accounts payable, accrued expenses, income tax payable. So a lot of stuff that looks familiar to us. And then finally, our net cash from operating activities.